And welcome to the Prescribing Prosperity Podcast with your hosts, John and Alex Soutsos. Gentlemen, good to see you both again.
Likewise, Bill. Good to catch up with you once again.
Great to see you, Bill.
Yeah, there are so many ways we could go with today's podcast, and I have a handful of notes here, and we have a lot of stuff to go over. But I got to start this by I got to ask you, because it does appear like this sad reality is going to be the truth. None of the original NHL Canadian teams are going to be in the Stanley Cup playoff. Guys, what has happened?
What are you talking about? Toronto Maple Leafs are first in the Atlantic Division.
So let's see if you're paying attention, John.
Montreal might even make it.
Montreal is in the playoffs.
Yeah, well, it's going to come down to the last game of the year. They're at them in Columbus.
And that's it as far as original Canadian teams. Everyone else is an add-on.
Yep.
I know. It's crazy.
There's only one Canadian team that matters, and it's Toronto, and we all know that.
Yes.
And we're the center of the hockey universe, and anyone who doesn't like that, I'm sorry.
Just ask Kim. Kim is an ardent supporter of the Leafs, if everybody remembers.
Kim Moody?
Man.
Yes.
He will appear in the middle of this podcast uninvited to punch somebody in the face on that. Okay. I don't even know where to pick this up because there are a couple of things going on. Anybody who's been paying attention to anything lately knows that the U.S. markets have been like some kind of scary amusement park roller coaster ride. You have an election coming up in Canada at the end of the month. And, there's just so much stuff going on in the markets that I guess maybe what we do is we just start with your take and your views on what's happening in the markets today. I don't know who wants to take that question first, but props to whoever does.
Okay, I guess I'll start off. So when you say markets, I assume you're referring to the U.S. market. And since our primary portfolio is a U.S. portfolio, then I guess we'll start there.
That sounds good.
So the interesting thing is that I think a lot of observers and a lot of market participants have really lost some perspective here. I think the new administration has been very clear that they have an agenda to restructure this company called United States of America. President Trump is the new CEO of this company, and this is a company that used to be a leader in its industry and has now fallen behind and is now in the middle of the pack, and they're trying to find a way to get back up to the front row, to use an F1 analogy. So when you take over a corporation, a company that is fallen into mediocrity, first thing you got to do is you got to secure your revenues. You have to find ways to enhance revenues. You have to find a way to cut your expenses. And you have to have a long-term agenda. And I think the new administration has checked all of those boxes.
You also have to focus on your key competencies, which is something that the United States has deviated from in the, I don't even know how far you want to go back, last 20 years, let's say.
It's been longer than that. I'd say it's closer to 40 years, very gradually. And it's been accelerated in the last 25 years, but I'd say going all the way back to the 80s is when a lot of this, the manufacturing started exiting the United States and going to other countries. But clearly during the 1990s and especially as far as China is concerned, in the late 1990s, I think it was in 2000 that they gained most favored nation status in the United States from trading arrangements. And ironically, that was the Democrats who allowed that to happen, even though they were very vocal in being against that.
Yeah, it happened during Bill Clinton's administration, yes.
Yeah, that's right. Yeah. So, and there's clear video footage of Nancy Pelosi and Chuck Schumer railing against Chinese trade and giving them a most favored nation status. And then it happened. And so that leaves open a lot of questions as to why, but we're not here to answer that. We're here to discuss what's going on right now. So there's a reset button being pushed by the new administration, and they've been clear that there's a transitional phase that they have to go through as a nation in order to get to the other side. And the other side is the reemergence of the United States as the leading economy of the world, and to assert their economic authority over the rest of the world, and to make it clear who's been paying the price in terms of many multinational organizations around the planet, and who's been paying the freight in terms of defense of Western civilization. So I think that's been made clear, but the new president is somewhat of a divisive figure. Half the population loves him and half the population does not. And that includes people that are involved in the investment industry. So being actively involved in the investment community and reading material from a variety of sources, I can see that some people just cannot see the perspective and are losing their minds over these tariff negotiations. And I think that's the thing that I want to make clear first and foremost, and that the administration made clear from the outset. Tariffs are not an end in themselves. They are a means to an end, and that end is to restructure global trading arrangements, and that's their primary objective. I think there is a secondary objective, and President Trump has mentioned that he would like to see a small tariff persist, whether it's 10% or 5% or whatever the final number is. He'd like to see a small tariff persist in pursuit of a situation like existed in the late part of the 19th century, which is the United States government relied exclusively on tariffs and excise taxes, et cetera, to pay for the cost of operating the government and relieve the income tax burden from American citizens. And I think that's a secondary objective. The first objective is restructuring trading negotiations to make them more balanced. So that's been made clear. At least it's been made clear to me. I don't know how other people interpret.
Well, I'm going to jump in and interrupt you for 1 second, John, because I like your reassuring metaphor of hitting the reset button.
Yeah.
Because in truth, that is what he did. But he is the prime advocate of chaos theory. He is
Yes.
the guy who walks into a room and is going to knock over every piece of furniture, grab the dinner table, throw it upside down, and make a mess, and then look at everybody and go, "Have I got your attention, or are you listening to me now?"
Yeah.
I appreciate that's his style, but it's like that's not always necessary to get people's attention.
It is not diplomatic.
No, it is not diplomatic. Thank you, John. Yes.
I think that is the principal criticism from most people who that even the people who are middle of the road that don't really like to take partisan sides in politics. I think that's their principal criticism of the president is he lacks traditional diplomacy of a political leader, especially the one who leads the free world. And people are having difficulty getting used to that. And I don't think those people will ever get used to his style. But
I think it's an issue, though, because it's an issue from the standpoint that people are focusing on the source of the message rather than the message itself. And to go back to your point about the reset, the goal or the focus of any government is primarily domestic interests, as it should be. The Canadian government should be focused on the interest of Canadians. The American government should be focused on the interest of Americans, and so on and so forth for other countries around the globe. And yet, because of the nature of his messaging and the way that he says everything and behaves, people decide that they want to attack him because they think that he's being mean and he's bullying people and he's being mean to other countries when that's not the case. His focus, as I said, is to improve the trade and economic circumstances for Americans. That is his primary concern. It's not his job to worry about how Canadians or other countries around the world perceive him. He doesn't care, and nor should he care.
yes, you are correct. He should be focused on his own country, as every leader, as you pointed out, should be focused on their own country. But there is some relevance to the style, and this is where a lot of people lose their mind. But let's get back to the capital markets. The capital markets have reacted with incredible passion to the proposals that have been made and the brinksmanship of raising tariffs to very high rates that were not expected on Liberation Day. We were told in advance, a month in advance, there's going to be a Liberation Day. It's April 2nd. It's coming. And I think the markets had already discounted some negatives, but they were not expecting the magnitude of the tariff arrangements announced on April the 2nd, and that's when everyone lost their mind. So we've gone through quite a bit of volatility. I've been communicating continuously with our client base to let them know that this is an event-driven market sell-off. Event-driven market sell-offs tend to be severe, steep, quick, and they tend to have a much faster recovery than systemic problems, as we had, if you recall, the 07 to 09 great financial crisis. That was more of a systemic issue. But
So John, just to interrupt you, you see this as a correction market, not a bear market. Is that what you're saying?
yeah, this is a cyclical bear within a secular bull market. So clearly, this is not going to be long lasting. This is transient. I think the transient period is going to be roughly 3 months. That's the clearly in the great pause that refreshes that was announced last week. It was 90 days. So 3 months of negotiation to get a new trading arrangements, and then we should have some kind of recovery. Now, at the same time, and what I'm also trying to emphasize to clients is that there's something coming after this, and that is a budget. And the budget is going to be very stimulative, but it's a budget that's prioritizing the private sector over the public sector. So this government, this administration is shifting from a public sector driven economic model to a private sector driven economic model, which as a libertarian minded person, I'm all in favor of, because anyone who believes in liberty and freedom and understands economic history in an objective fashion, not in an ideological fashion, knows that the economy functions better with less government. Now, what that exact number is, that's a debate for another day, but it is clearly not 40% government or 35% government. Is something significantly below that. And I think as the Doge people in the United States have demonstrated in trying to make government more efficient, is there's a lot of waste that's been occurring in the U.S. government, and I would venture to guess that it's the same thing in Canada and the rest of governments in Western civilization. So this is a transient process. So they're securing revenues, they're cutting expenses, and they're restructuring, pressing the reset button on trade negotiations. Once that transition period is over, and we start getting the private sector stimulus bill that's coming with deregulation, tax cuts, more cheaper energy, which is a big one. And in fact, we've already had a discount in energy. Oil prices are down roughly 25% from their peak when the new government took over on January 20th. So all of these things are going to filter into the economy in the second half of this year. So this is a temporary situation. As I said, he's a very divisive leader, and in the capital markets, it's the same thing. Half the constituents of the capital markets in terms of making trades don't like his plan, and half do like his plan. So you're going to get this volatility. But if you screen out the volatility and you take a look at it, what has actually transpired from April the 1st, the day before the Liberation Day announcement of the tariffs, until the close of business yesterday, the S&P 500 was down 4.2% approximately, which is not good. Obviously, we're talking about a span of 2 weeks. However, it's not the end of the world either. If you recall, during the pandemic, from March 1st to the end of March, the market was down roughly 25% or so. And from the peak, from February 1 in 2020 until the end of March, it was down 33%. So, yes, we're off the peak here in this year, but I'm speaking now specifically about these tariff negotiations. From April 1st to the present, we're minus 4.2. Our model portfolio is down 0.8. So we're holding up significantly better
Makes me envious. My own personal portfolio has taken a whacking during all of this. So
Yeah, well, if you're skewed toward the technology sector, you've taken a big hit. Nasdaq is down significantly more than the S&P 500 is. But in our portfolio, I've been systematically and gradually de-risking and moving to defensive sectors. It's not 100% consumer staples, if that's the guess of anyone out there. We do have consumer staples as a material portion of our portfolio, but we have other defensive stocks and sectors represented in the portfolio today. And the one thing I've noticed in the transition process is a lot of the companies that have done well in the last 2 weeks, 3 weeks, month, the defensive companies, if you look at their fundamentals, they're not very strong companies. In other words, had we not had this interruption to quote unquote normal, these companies would not be companies whose financial statements would endear themselves to investors looking for long-term capital growth or even near-term capital growth. Yet they've been picked up like they're the greatest thing since sliced bread, and they're not. So when I transitioned the portfolio, I was very careful to select not only companies that are in the defensive sectors like staples, utilities, and support services, et cetera, communications, that these companies also have some fundamental strength behind them.
that lends credence to your argument that you see this as an overdue correction as opposed to a bear market, really.
Yeah, I didn't say that, but I think thank you for saying it, because I think there was a lot of people heading into the month of February, and not just heading the month of February. I mean, the chatter was out there for the last 6 months that this is a very expensive market. And so no one had a catalyst before this, and all of a sudden we've got a catalyst. And so we've seen that. And actually the catalyst was DeepSeek, which was announced at the beginning of February. I think that was the first catalyst, and the market peaked out 2 weeks later.
It's also important to note that, this is not altogether uncommon. So over the last 45 years, going back to 1980, we've had 25 corrections / bear markets. So let's first establish the difference between the two. So a correction is anything greater than negative 10%, or anything between negative 10% and negative 19.999%. Anything over 20%, negative 20%, is a bear market. So what we've had so far this year has gotten very close to bear market territory. On an intraday basis, we actually did touch it. But if you're just looking at closing values in the S&P 500, we haven't actually hit bear market territory. We are still in correction. We topped out at about 18.9% on, I believe it was April 8th, if I'm not mistaken. I'd have to go back and double check the dates on that. But anyway, suffice it to say that we've had a correction intra-year here so far of at least 19%. And going back throughout history over the last 45 years, that has happened 25 times where we've dropped at least 10% in the single year. So 55, almost 56% of the time, we have had an intra-year correction and or bear market. And in those 25 instances, 14 of them, again, 56% of them, we still ended the year positive. So what is going on right now is a lot of people, I've been hearing a lot of people say, this could be, a return to the 08-09 financial crisis. This could be 1929 all over again. And a lot of that is overblown hyperbole. The systemic issues that existed in 2008, 2009 are not the same issues that we're facing today, as my dad's already mentioned. And what happened in 1929 was exacerbated by the exact opposite behavior and intervention that should have occurred in order to mitigate some of those downside risks. And so it's unlikely that we would face a situation like that again right now. So for all the people who are running around with their head cut off, it's really not warranted. And as a matter of fact, if you look at what happened on, when was the pause? Was it April 9th?
Yeah, April 9th. That's right. Yeah.
So April 9th, we had the markets rebounded 9.5% in a single day in the S&P 500, led by the most aggressive sectors, led by tech and consumer discretionary. That's an indication that there's a lot of money that's sitting on the sidelines that is just waiting to be deployed. And people are looking for an opportunity to go. They're just trying to find, have we hit that bottom yet? And I know we're going to get into it a little bit more further on in the episode, but I wanted to provide some historical context so that people understand this is not unusual what's going on this year.
No, it is not unusual. And just to add to your comment about the 9.5%, some of that is money, the money on the sidelines that's looking to get back in at a good price, but some of it is also short covering. And short covering can also have a significant impact when you have huge one-day moves like that. But getting back to historical precedent, I've been in this business for 4 decades. I've been through a lot of market corrections. I've been through quite a few bear markets, and this does not scare me. I'm not scared in the least. It also helps that I understand the big picture. Anyone who cares to pay attention to the details, and not everyone does. A lot of people just listen to their TV or radio and they think they've gotten some kind of depth and insight on what's going on, and they haven't. If you're paying close attention to the U.S. administration, they make their announcements and their intentions very clear. So there is a process unfolding. The process is going to take 3 to 4 months from the time the process began. And it's in the short term going to has caused a dislocation in capital markets. It's provided perhaps some short-term deceleration in the U.S. economy, although it's still in growth mode. What is not noticed yet, at least not in the public view, is industrial production in the short term has really popped on the expectation that a lot of companies are reshoring, companies that have already begun that process. No one's paying attention to the fact that there's this massive stimulative budget that's coming sometime in the next 4 to 6 weeks, which is going to cut taxes, deregulate, begin the process of deregulation, expand energy supply, and that I can't emphasize enough how huge that's going to be in terms of stimulating the economy. So, and if the United States does manage to get the second part of the trading strategy arranged, which is an enduring tariff of maybe 5% or 10%, and does manage to eliminate income taxes, if not for everyone, then for those people. I think what's been discussed publicly is anyone up to $150,000 a year of income. If you get in the elimination of income tax for that segment of the population, the economy is just going to tear up. It's in a good way. It's going to move. It's going to take off like a rocket, and so. Think about the offsetting. Some things in the short term, due to the inability of substitution to replace all imported goods, you might have some short-term price increases in some areas, but then you're going to have a lot more money in your pocket because you're not paying the same amount for gasoline. The price of goods are going to drop because transportation costs are lower, and you're going to have all this deregulation. Companies will be more entrepreneurial, they'll expand faster, more jobs will be created, et cetera, et cetera, et cetera. So we're now in April. By December of this year, I would not be at all surprised if the market is back to where it was in the middle of February, which was up around 7% from January 1st. I would not at all be surprised if we're back there by the end of December. And if it doesn't happen by the end of December, sometime early in 2026, sometime in January.
Before we get into the inflation stuff, because you kind of briefly touched on it there, Dad, I think it's also important to mention a couple of other things. So domestic investment, you talked about on the industrial side, but even from not necessarily, and I guess it is still on the industrial perspective, but looking at some of the major technology companies in the United States have invested over $3 trillion already in increasing production in things like chip manufacturing and reshoring production back into the United States as opposed to having it produced globally. That is already an incredibly stimulative action in and of itself.
Yes, it is. It hasn't happened yet. These are all commitments. Yeah. So shovels haven't hit the ground, so to speak, metaphorically. Yeah. But you're right. Those are going to be incredibly stimulative. And just to getting the commitment, I think psychologically is very beneficial. Contrast that to our country here in Canada, where we've had a net loss of foreign business investment of over $250 million or $250 billion in the last decade. So we're losing foreign business investment. Meanwhile, the United States is attracting $3 trillion, or at least getting commitments for $3 trillion. So that tells you the direction of each of our countries.
Yeah, exactly. And just to pull it back to the tariff topic just one last time, because there's a couple other points that I think are worth noting. We talked about the fact that the utilization of tariffs was a negotiating tactic, and it was not done indiscriminately, despite what people have said. You'd be shocked to hear some of the conversations that I've heard, Bill, over the last few months. People think that he just walked out of the bathroom and turned around and said, "Cambodia, coming after you," and Germany, you're next.
In their defense, it's easy to imagine that having happened, but I don't.
Yes,
I don't believe that's that's what went on.
No, and so what people don't understand is that of the G20 countries, the United States is the most tariffed out of all of them. They face the largest trade barriers relative to everybody else, and it's not just tariffs. There are non-tariff barriers that people don't know about. So people will say, "Oh, well, they're only charging 20% on their tariffs, and he charged them 40%. Well, have you considered non-tariff barriers? Have you considered things like value-added taxes? Have you considered things like currency manipulation? Have you considered the fact that a lot of times countries will reroute trade through a third party in order to avoid tariffs? China's notorious for that. China will route things through Vietnam and other countries in Southeast Asia in order to avoid being tariffed by the United States. And so there are a lot of different tools that countries can use in order to try and gain a benefit when it comes to international trade policy. It's not just tariffs.
Well, I think that people have also lost some very important perspective, and I'm not sure if it was Scott Bessent who mentioned it, but someone mentioned the fact that the stock market is owned by the top 10% of society in the United States. And that, by extension, I think that would apply to Canada and the Western Europe. Whereas the objective of this administration is to bring jobs to the middle class, to the bottom 50% of society. So for 25, 30, 40 years, we have all this hand-wringing in government, whether it's left or right, mostly on the left, but hand-wringing about the increase in the gap between rich and poor. And it's exactly globalization that has caused this expansion in the gap between rich and poor. And here you have a president who's trying to address this issue, try and bring jobs back to the bottom 50% of society in the United States. And he's being vilified as doing tax cuts for the rich, which is nonsensical. Because when you get rid of, and it hasn't come yet, but eliminate tax on tips, eliminate tax on overtime, and potentially eliminate income taxes completely on people whose earnings are under $150,000 a year, that is trying to help the bottom part of society. So the gap between rich and poor is diminished. But there's no credit being given for that. It's only criticism. And I think people have to gain a little bit of perspective that the people who are most financially capable of adjusting to the current market dislocation, they're only dealing with a short-term issue. Whereas the bottom half of society has been dealing with economic disparity for two generations. And they're trying to deal with that in a more productive fashion.
I think it's also worth noting, you mentioned globalization there. What was the original purpose of globalization? It was a strategic phenomenon, if you recall. I know you will, Dad. I don't know if you're familiar with this, Bill, but it was a strategic decision during the Cold War in order to try and limit the spread of communism by creating greater interdependencies between, at that time, free nations and trying to isolate some of the communist countries. They were trying to create a system in which those countries were dependent upon each other and therefore were incentivized to not turn to a communist regime. And therefore, the United States sacrificed a portion of their economy, a portion of their manufacturing and production capacity in order to maintain a free society globally.
Yep. No, and in fact, I would argue that it is at that point when we went to a strategic trade that we moved away from what had been classically defined for generations, what the free trade was supposed to be, quote unquote, free trade was supposed to be, trade that was facilitated by companies that had comparative advantages, meaning at its silliest level, right? You grow mangoes, I can't grow mangoes here, and I make this here, so we'll trade what I can make here for your mangoes, all right? And I don't mean to sound silly, but that was the idea.
Of course.
And then in the process of that, what has happened is that, we have gone to trade that is based on absolute advantages. And what I mean by that is that China can pay its workforce 15 cents an hour, 20 cents an hour, and therefore they can win because they will always be the absolute lowest bidder, as it were, in terms of making products. So it's kind of twisted our old definitions of free trade without any of us recognizing it. John, go ahead.
This is a lot like the American Civil War. What advantage did the South have? They had slave labor.
Right, exactly.
And that's essentially China. China essentially has a lot of slave labor at their disposal, if not in absolute terms, in metaphoric terms, significantly cheaper labor. Now, mind you, that cost of labor is starting to increase over the last 10 years, I'd say. But that is really the big advantage China has. Not only that, but they have a centrally planned economy. They have someone who can dictate how everything's going to work out. But how's that worked out for them so far? What a lot of people listening to this podcast don't realize is the Chinese economy is in serious trouble right now. They're experiencing their great financial crisis in terms of real estate. But people seem to think that that China is this great economic power that's going to overcome the U.S. and they're going to band together with a few other countries that are on the perimeter, like Russia and Iran and others, and all of a sudden offer an alternative currency to be a trading currency, and that's nonsensical. They're in serious economic trouble. The Russian economy is undiversified. India has improved quite a bit, but they're still not a country that could potentially take the place of the United States in terms of all of its economic character. And China has serious financial difficulties right now. They have not recognized the devaluation in their real estate. They have unproductive loans on their books in terms of the banks. So they're in serious trouble. And they also are holding a lot of US dollars, and they can't afford to dump the treasuries because they're actively trying to devalue the renminbi against the US dollar to try and maintain their trading advantage. And so it would be contrary to their strategy to try and dump U.S. treasuries, which is another theory that's been floated out there by a lot of naysayers. So this is not a simple solution. I think what has been made clear by the Trump administration, for those people who are paying close attention, not everyone is paying close attention, is the Trump administration is systematically trying to isolate China. All these insults against their allies, including us here in Canada, this is all done by intention and by design to get the allies into a free trading bloc or something close to free trade, and in order to counteract the threat from Chinese low-cost production, and also to isolate them so they don't try to have any expansionary objectives or to reduce their expansionary objectives. So there's a really big picture here that people are losing sight of, and nothing happens by accident. I know a lot of people who don't like Trump think he wakes up in the morning, screws his head on, and sometimes he misses a few threads, and he comes up with these crazy ideas from one day to the next. But this is all by design. The people who surround him in the cabinet are highly accomplished individuals, and they have a plan in place, and they're executing their plan. And it's very disruptive in the short term, and none of us like it in the short term. But sometimes there has to be some short term pain to have long term gain, to use a metaphor from the fitness business.
Well, it is extraordinarily disruptive, and that's not a controversial statement. I mean, anybody's looked at any of the financial markets in the United States realize that. It's also disruptive to Canada's politics, and I don't know if we want to break here and come back to talk about what's happening in Canada in terms of the election that you've got coming up and the influence of what has happened down here on your political scene. And
I think we'll leave the Canadian discussion for the next episode. I think right now one of the things that we should touch upon is just going back, steering this back towards the financial markets and where they're currently at right now. I mentioned before how April 9th we had that big jump, and that was one positive sign. Another positive sign seems to be changing consumer sentiment on both the consumer side as well as on the investor side. So sentiment is a great contrarian indicator that I think a lot of people fail to notice. Whenever they look around and they see everybody else is panicking, they think that means it's time to panic, when it actually should be the opposite. Warren Buffett is famous for saying, when others are fearful, that's the time to be greedy. And, right now what we're looking at is people are going to a state of extreme fear. I actually had a client, and my dad mentioned this afterwards, that it should have been a red herring to him. But anyway, that a client reached out to me on April the 8th, and he said, oh my God, considering everything that's going on with all the craziness that's happening in the market, should we reevaluate my strategy, and should I be buying more GICs and getting out of the US markets? And talk about the absolute worst thing to do. I'm going to sell my equities at a loss and lock in a rate of return that's going to get me on a net of inflation basis negative. So you don't want to be doing that, but that's people's emotions taking over. And so what's going on right now, if you look at a couple different indicators, so the University of Michigan, for example, has a sentiment indicator, a consumer sentiment index that they've been publishing since the 1970s. Anytime that indicator gets below 55 or 50, that tends to indicate extreme pessimism, and it tends to coincide with a bottoming of the market, either immediately or shortly thereafterwards. Right now, we're at 50. Similarly, if you look at the equity-only put-call ratio put out by CBOE, for people to get a bit of context here, puts are options contracts that give people the right to sell a security at a given price. So if you are very pessimistic, you want to buy puts because you can potentially sell a stock at a price that is above the current market price.
Or at the current market price, or slightly above.
Correct. The calls, for conversely, are what you buy if you are optimistic. So calls give you the right to buy a security at or below the current market price. And so if you think that the price is going to go higher, you can potentially buy it for less than it's currently worth. So the ratio of puts to calls is a good indication as to how pessimistic or optimistic the market is getting. If the ratio of puts to calls exceeds 0.75, that is an indication that the market is overly pessimistic and we are approaching a bottom. And right now we're at 0.97. So that's for every one call that people are buying, they are buying one put. Historically, the normal range is about 0.6. People tend to be more optimistic, which stands to reason. The market tends to increase about 73% of the time, going back to the 1920s. And so that makes sense that people would be more optimistic than they are pessimistic. And so the fact that we're at 0.97 indicates that we are at an extreme level of pessimism in the financial markets. And therefore, we are either at or very close to a bottom. Now, that doesn't mean that we couldn't print a second bottom. We couldn't have a double bottoming pattern that could happen. That happens all the time in financial markets, especially when it's driven by macroeconomic news. We can see situations where a market will slip back into a correction or bear market territory temporarily. But generally speaking, we've reached the level of extreme, and we are going to be rebounding off of that extreme very soon. And so this should be a very good opportunity for people to buy at or near the bottom of the market and capitalize on the rebound.
And that is manifested for people who are interested in getting a better handle on that. There's something called the Volatility Index, or the VIX Index. And so when puts are elevated relative to calls, the VIX Index is going up. And when the opposite happens, the VIX is going down. The general barrier between optimism and pessimism is 20. So if the VIX Index is above 20, you have more pessimism. Under 20, you have more optimism. And definitively below 17, you have more optimism, or less fear, I should say. And right now, the VIX Index is at 33.3, which is quite high. And it did reach a peak last week of 60. So we're off the extreme valuations. But still, there's a lot of fear in the market. And that means for now, people can keep that in mind when they're making their decisions. I can tell you that our portfolio is holding up very well in this situation. Going back to where we were at the peak of the market until close of business yesterday, the S&P is down 11.82. So that sounds like a lot. But yeah, the S&P is down 9.25% from March 1st to the present. Our portfolio is down 6.2. So we're 3 percentage points clear, or in relative terms, 33% less risk on the downside for our model portfolio. And today, I can see that the market is having a bad day, triggered primarily by some negative news on Nvidia. So it's disruptive to do that, but we're holding up well. Our portfolio is down significantly less than the market today. I'm just trying to pull up some current numbers. So the market right now, S&P is down 2.75, the Nasdaq's down 4%, and our portfolio is down barely over 1.3%. So we're doing our job to protect capital on the downside, and I think 3 months from now we're going to be having a conversation about, wow, what a rebound this has been, and people need to keep perspective and not panic about on day-to-day activity.
Just one last point before we wrap it up here is, we were able to achieve that not necessarily by exiting the market. We're still fully invested, but we've just tilted the portfolio in a more defensive nature, and that's one of the advantages of having an active portfolio manager managing the portfolio and having that tactical allocation to be able to say, okay, the current conditions no longer favor growth. We've got to tilt to take on some of these headwinds, but it's better to tilt than to fully go to cash, because the rebound tends to be quick and the magnitude can be significant. The 5 best days in the market generally follow bottomings, and nobody knows exactly when the bottom is going to happen. We have an idea. I mentioned that we're approaching a bottom, but I'm not going to sit here and say to you April 18th is going to be the absolute bottom. And so by staying invested and maintaining exposure to the market, you are benefiting yourself or giving yourself the opportunity to capture a good portion of that upswing when that bottom does occur and the market does start to rebound.
For the record, today's April 16th.
Details.
Just in case someone in the future listens to this podcast and it was wrong by 2 days.
I don't think it's got a bottom on a Sunday, but
we shall see. Let's leave this conversation here for now. For those of you who are listening to this, please join us on part 2, because in part 2, we're going to get into a little bit of the politics of America and how they're impacting the politics and the elections of Canada. But in the meantime, John, Alex, if people have been listening to this conversation, find it interesting, find it potentially useful to them, what is the best way for them to reach out and get a hold of you?
They should send us an email at info@medwealth.ca. That's info@med-wealth.ca.
Fantastic. And for those of you who are listening and don't have something to write that down, it's in the show notes. Don't worry, you can go look at it in a little while. The other thing I would suggest you do too, please, is if you're not a subscriber already, hit follow. That way, every time a new episode, like, for example, the second half of this conversation comes out, you'll be notified and you can continue to listen. I would also ask that if you like the podcast, tell people about it. Give it a good rating. Word of mouth promotion is invaluable, especially in today's world where you've got bots recommending all kinds of stuff and you don't know who really likes what. So word of mouth, very much appreciated, as a matter of fact. Until next time, or in this case, until part 2, I'm Bill Tucker on behalf of John and Alex and everybody at MedWealth. Thank you for taking the time to listen. And do remember this, you can go out today and make today a great day. Or not. The choice is yours. See you next time.